Understanding key rate duration. Key rate duration is a fundamental concept used in finance, particularly in the realm of fixed-income investments like bonds. It provides investors with a tool to assess how the price of a bond or a portfolio of bonds responds to changes in interest rates at specific points along the yield curve. In an environment where interest rates fluctuate, understanding key rate duration can be pivotal for managing risk and making informed investment decisions. What is key rate duration? Definition. Key rate duration measures the sensitivity of a bond's price to changes in yield at specific maturities along the yield curve. Unlike effective duration, which assumes a parallel shift in the yield curve, key rate duration is particularly useful for evaluating price changes when the yield curve experiences non-parallel shifts. Importance of key rate duration. 1. Risk measurement. Key rate duration quantifies the risk associated with holding fixed-income securities. Investors can estimate potential price changes in response to interest rate fluctuations, aiding in portfolio risk management. 2. Precision in investments. By focusing on specific maturities, key rate duration allows investors to compare the sensitivity of different securities across varying time horizons. This granularity can enhance decision-making for interest rate strategies. Key takeaways. Calculation method. Key rate duration represents the change in a bond's price in response to a 100 basis point, 1%, change in yield for a specific maturity. Non-parallel shifts. While effective duration is used for estimating impacts from parallel shifts, key rate duration is essential for estimating changes when the yield curve moves non-parallel. Comprehensive view of risk. Understanding both key rate and effective duration allows investors to grasp a more comprehensive view of interest rate risk in their portfolios. The formula for key rate duration. The formula for calculating key rate duration is as follows. Backslash text, KRD, equals frac, P plus, 2 times delta Y times P_0, where P_price of a security after a 1% decrease in yield. P plus price of a security after a 1% increase in yield. P_0 the original price of the security. Delta Y change in yield, 1% in this case. Example calculation. Imagine a bond is originally priced at $1,000. A 1% increase in yield results in a price of $970, while a 1% decrease in yield results in a price of $1,040. Using the formula backslash text KRD equals frac 1040 to 970 2 times 1 percent times 1000 equals frac 70 20 equals 3.5 . Thus, the key rate duration for this bond is 3.5. Interpreting key rate duration. Understanding the implications of key rate duration can be complex, but there are practical ways to apply this metric. 1. Sensitivity analysis. Key rate duration allows for comparative sensitivity assessments across different bonds. For instance, if bond X has a 1-year key rate duration of 0.5 and bond Y has a duration of 1.2 for the same maturity, bond Y is more sensitive to interest rate changes. 2. Portfolio management. Investors managing a portfolio of bonds can sum individual key rate durations across different maturities to derive an effective duration, which provides insight into overall portfolio interest rate risk. 3. Strategic actions. By analyzing key rate durations, investment strategies may be fine-tuned to emphasize or mitigate exposure to specific maturities based on expected market movements. A practical example. Consider two bonds with the following key rate durations. Bond X, 1-year duration of 0.5 and 5-year duration of 0.9. Bond Y, 1-year duration of 1.2 and 5-year duration of 0.3. In this scenario, it can be noted that bond X is less sensitive to interest rate changes at the short end compared to bond Y, while for the intermediate term, bond Y demonstrates more sensitivity. Conclusion. Key rate duration is a vital tool for investors in the fixed income market, providing insights into how interest rate changes can affect bond prices across different maturities on the yield curve. With this understanding, investors can better manage risk and align their investment strategies with their expectations for interest rate movements. In an ever-changing economic landscape, the ability to accurately gauge the impacts of interest rate shifts can be crucial for successful bond investing.